Hi everyone, today we want to talk about the stock market crash 2020 and the banking industry. As coronavirus slowed down global economic growth, the market is theoretically heading towards a possible stock market collapse for the financial crisis in 2020. According to many analysts, given the current market history, the stock market crash of 2020 is possible. The stock market crash occurred when the market and the stock dropped sharply within a day or several days. Next is the causes of the stock market crash 2020. First, pandemic COVID-19. Second, the oil war between Russia and Saudi Arabia. And the last, panic investor. First is pandemic COVID-19. The sector of traveling and tourism have a huge impact because of the travel restriction need to be adhered to in order to stop the spread of this coronavirus. February 2020, many stocks in the Dow Jones Industrial Index, Nasdaq Composite and S&P 500 Index were closed. Next is the oil price war between Russia and Saudi Arabia. Due to the inability of the agreement to reduce crude oil marketing, Saudi Arabia and Russia have announced an increase in oil production. As a result of the action taken by them to increase crude oil production, the oil price started to fall by 25%. And the last one is the panic investors. Investors worry to buy the lower price stock because of the feel like the stock continue to decline and uncertainty ability to success. They only will look for the stock when the economy and outlook of the economy are stable and they are more secure to invest in. Next is the risk that involved in the banking industry due to stock market crash 2020. First, credit risk, liquidity risk, reputational risk, operational risk, systematic risk, interest rate risk, sovereign risk. First, credit risk. Stock market crash will lead the borrower unable to pay their debts or delay their payment to the bank due to the stock market crash. To reduce it and make sure the profitability bank always high, banks should have a strategy and conduct the individual who want to take the loans. Second is liquidity risk. During the stock market crash, banking industry will have less ability to grow and not many customers will come to deposit their money in the bank. Third is reputational risk. Reputational risk occur because bank is not able to meet the obligation when their customer want to withdraw their money that will bring a bad reputation to the banking industry. Operational risk. During stock market crash, operational risk occur when the payments are credited to the wrong account or executing an incorrect order while dealing with the market. Systematic risk. Systematic risk is the risk that arises because the financial system is a connected system. Systematic risk does not occur on individual banks, rather they will affect the entire system. Interest rate risk. During stock market crash, interest rate is likely to drop. This result will drop the profitability of the banking industry. Interest rate and the bank profitability are connected to each other. Low interest rate result give the pressure to the net interest margin. Thus, the profitability of the banks will reduce. And the last one is the sovereign risk. Sovereign risk is the risk from the impact of crisis in economy or political crisis in foreign sovereign nations. The rise in sovereign risk will affect bank funding costs through various channels.